On January 14th, 2026, 1 ounce of silver traded at $92 in New York. That same day, in Shanghai, the identical ounce, same metal, same purities, settled at $104, $12 apart. Not a rounding error, not a temporary glitch, a systematic divergence in the price discovery mechanism for a globally traded commodity. This isn't supposed to happen. Arbitrage exists to destroy price discrepancies. Traders buy low, sell high, ship the metal, collect the spread. The gap closes in hours, maybe days. But this gap has been widening for weeks. Physical silver is leaving Western vaults and not coming back. Eastern buyers are paying premiums that make no sense, unless the metal isn't actually available in the West at the quoted price, which raises a question that sounds simple but cuts straight through to the foundation of modern commodity markets. What happens when the paper price and the physical price stop talking to each other? And the danger wasn't in the price, it was underneath it. If this walk through financial history sharpened how you understand risk, take a moment to like the video. It quietly tells the system this work has value. Because what's happening in silver right now isn't new, it's a pattern. The pattern has a structure. Silver trades in two worlds. In New York, on the COMEX exchange, futures contracts move billions of dollars daily. Speculators, hedgers, algorithmic traders, all betting on price direction with contracts that rarely demand physical delivery. It's efficient, liquid, fast. In Shanghai, at the physical settlement benchmarks, actual metal changes hands. Factories need it for solar panels. Electronics manufacturers need it for circuits. Defense contractors need it for components. The price reflects what someone will pay to hold the metal, not to bet on it. For decades, these two markets moved together. Price discovery happened simultaneously across time zones. Arbitrage kept them aligned, but arbitrage requires one critical condition: the ability to move the underlying asset from where it is cheap to where it is expensive, and that condition is breaking. At the time, this looked stable. What no one questioned was the structure holding it up. The modern commodities futures system was built to solve a real problem. In the 1970s, after the collapse of Bretton Woods, price volatility in metals became a significant risk for industrial producers. Airlines needed to hedge fuel. Manufacturers needed to lock in copper and silver costs. Farmers needed forward contracts. Futures markets provided certainty. A factory could buy a contract today, guarantee a price 6 months out, and plan production accordingly. The system worked because of one documented assumption: that financial settlement could replace physical delivery for the vast majority of contracts. This wasn't a trick. It was efficient. If 98% of market participants only wanted price exposure, not the metal itself, then exchanges could operate with a tiny fraction of physical inventory backing enormous notional value. Leverage made the system liquid. Liquidity made it trusted, but the assumption embedded into the architecture was this: physical demand would remain predictable, stable, and small relative to paper trading volume. What policymakers and exchange architects genuinely believed was that derivatives would always remain supplementary to the physical market, not larger than it. They built the plumbing for a world where paper amplified price discovery, not replaced it. It worked, but only under conditions that would not last. Through the 1980s and 1990s, the system delivered. Silver futures became a standard hedging tool. Industrial users locked in costs. Speculators provided liquidity. Exchanges expanded margin systems, allowing traders to control large positions with small capital. Prices stabilized relative to the chaos of the 1970s. Volatility compressed. Confidence grew. But with each expansion came a trade-off. As notional trading volume grew, the ratio of paper contracts to physical inventory widened. By the early 2000s, open interest on COMEX silver represented multiples of annual global production. This wasn't fraud, it was leverage. The unintended consequence was that price discovery began migrating away from physical transactions toward speculative positioning. Another success: exchange-traded products made silver accessible to retail investors. Funds like SLV accumulated physical inventory, creating visible stockpiles. This reinforced confidence in the paper market. The deferred risk: those stockpiles became the system's shock absorber. When demand surged, vaults could be drawn down. When demand cooled, they refilled. But the buffer wasn't infinite. By the 2010s, silver's industrial demand was accelerating. Solar panel production, heavily reliant on silver paste for conductivity, was doubling every few years. Electronics, EVs, defense systems, all pulling from the same finite supply. At the same time, mining supply growth was slowing. Most silver is a byproduct of copper, lead, and zinc mining. When those base metals underperform, silver supply stagnates, regardless of silver's price. The result was temporary stability built on inventory drawdowns. Prices improved modestly. Volatility remained low. The system looked robust. But the plumbing tightened with every passing year. COMEX inventories, which had peaked near 200 million ounces in 2015, began a steady decline. By 2023, they had fallen below 80 million ounces. No one panicked. Drawdowns were explained as normal market function. What wasn't emphasized was the reduction in the system's margin of error. The first documented strain appeared in late 2023. Physical premiums in Asia began rising above historical norms. Shanghai prices started trading at a persistent premium to London and New York, initially just $1 or $2. This made sense. China was expanding solar capacity aggressively. Demand was rising faster than imports could adjust. But the premium didn't correct. By mid-2024, India's industrial buyers began reporting delivery delays on COMEX contracts. Some chose cash settlement rather than wait for physical allocation. In July 2024, Russia quietly announced it would begin accumulating silver alongside gold in its central bank reserves. A policy shift with little precedent. These were signals, inconvenient but interpretable. Western analysts mostly dismissed them. COMEX inventories were low but stable. Spot prices were rising, but not alarmingly. ETF holdings weren't seeing massive outflows. What was missed was the slow deterioration in the system is core assumption that financial and physical markets could be cleanly separated. Asian buyers were increasingly unwilling to accept paper settlement when they needed the metal itself, and Western vaults no longer had enough slack to absorb that preference shift. Pay attention to this part. On January 1st, 2026, China implemented export restrictions on silver. The stated reason: national security and industrial supply chain resilience. The practical effect: domestic Chinese demand could no longer be relieved by outflows to lower price markets. Shanghai prices immediately spiked. But here's the critical detail. COMEX prices in New York barely moved. A $10 gap opened within 72 hours. Arbitrage traders should have flooded the market. Buy in New York, ship to Shanghai, collect the spread. Except COMEX inventories were already near multi-year lows. Eligible stocks, metal available for delivery, had dropped to roughly 40 million ounces, and most of it was already spoken for. The gap widened to $12 by January 14th. Nothing collapsed. And that was the problem. The system was still functioning. Contracts were still trading. Prices were still being quoted. But the mechanism connecting paper and physical had quietly decoupled. The decision point came earlier than most realize. In late 2024, when Shanghai premiums first began persisting, COMEX officials faced a choice: tighten delivery requirements to ensure physical backing, or maintain high leverage to preserve liquidity. They chose liquidity. This wasn't negligence, it was institutional logic. Tightening delivery rules would have forced margin calls, reduced open interest, and potentially triggered a liquidity crisis in the broader commodities complex. The reasoning was sound. Most contracts settle financially. As long as speculators and hedgers could trade freely, the market would self-correct. What this reasoning failed to account for was the possibility that physical buyers might stop accepting financial settlement altogether. By early January 2026, that shift was underway. Chinese manufacturers, facing domestic shortages due to export restrictions, began paying whatever price Shanghai quoted, because the alternative was production halts. Indian refiners, historically major suppliers to global markets, started prioritizing domestic buyers. Dubai and Tokyo, both major physical trading hubs, saw prices spike even higher than Shanghai. Reports of $115 to $130 per ounce emerged in certain spot transactions. Meanwhile, COMEX remained anchored near $92. The spread wasn't irrational. It was the market revealing a truth that had been obscured by decades of leverage. There was less deliverable silver in Western vaults than the paper market implied. From this point on, the outcome was no longer optional. The immediate beneficiaries were clear. Holders of physical silver in jurisdictions without export restrictions saw their inventory appreciate by 10 to 15% relative to paper positions overnight. Mining companies with production in the Americas or Australia gained significant pricing power, though most were locked into forward delivery contracts at lower prices. Sovereign buyers accumulating metal, Russia, certain Middle Eastern entities, effectively purchased at a discount before the fracture widened. The cost was absorbed by three groups. First, industrial manufacturers in the West who had relied on stable COMEX pricing for hedging and procurement. Their contracts settled financially, but acquiring actual metal required paying Shanghai equivalent premiums, a gap their risk models hadn't anticipated. Second, speculative long positions in paper silver who discovered their contracts offered exposure to New York pricing only, not global physical reality. Third, the credibility of the futures exchange itself as a price discovery mechanism. Power shifted structurally. For the first time in decades, price-setting authority in a major commodity began migrating east, not because of speculation, but because of physical flows. Shanghai became the reference price for transactions requiring delivery. New York remained the reference for financial bets. The market had bifurcated. This wasn't a temporary dislocation. It was a reordering of which participants set the marginal price. Industrial buyers with production needs now dictated premiums. Speculators with leverage dictated volatility. But the two were no longer influencing the same price. If you value analysis that treats financial history seriously, subscribing simply ensures you don't miss work like this. The implications extended beyond silver. Other commodities with similar inventory to trading ratios began showing strain. Platinum, palladium, certain rare earth elements. Each had built leverage on the assumption that physical demand would remain secondary to financial positioning. Each was discovering that assumption had limits, and those limits were being tested quietly across the global commodity complex. This pattern isn't new. In 1971, the dollar's convertibility to gold ended because foreign central banks requested physical delivery that U.S. reserves couldn't fulfill at the stated price. In 2008, certain credit derivatives traded normally until counterparties demanded settlement and discovered the underlying assets no longer existed at the assumed valuations. The mechanism repeats. A system builds leverage on the assumption that most claims will never be exercised simultaneously. That assumption holds until a preference shift occurs. When enough participants decide they want the underlying asset, not the derivative, the system reveals how much slack it actually has. History doesn't repeat events. It repeats incentives. Right now, in commodities markets, the incentive structure is shifting. Geopolitical fragmentation is increasing the value of physical possession relative to contractual claims. Industrial demand for critical materials is rising faster than mining supply can respond. Energy transitions, solar, batteries, electrification, are pulling on commodities that were historically stable, and inventories that once provided buffer capacity have been drawn down to levels that offer little margin for error. The silver fracture is a symptom. The underlying dynamic is broader, late-cycle tightness in systems that rely on just-in-time delivery and high leverage. Prices are the headline. Plumbing is the story. When Shanghai and New York diverge by $12, the question isn't which price is right. The question is which market actually has the metal, and the answer matters far more than the spread. This isn't a prediction that markets will collapse. It's an observation that certain mechanisms are operating at reduced flexibility. Rolling top logic applies here. A market can look strongest, highest liquidity, tightest spreads, most confident participants, precisely when its structural capacity to absorb shocks is narrowing. Complacency isn't the absence of risk. It's the absence of awareness that slack has diminished. What's rational for individuals, holding paper exposure, trusting exchange settlement, relying on historical arbitrage, can become collectively unstable if enough participants shift preference simultaneously. The current environment rewards positioning, not prediction. Understanding where physical inventory actually sits, recognizing which contracts have enforceable delivery, distinguishing between price exposure and asset ownership. These aren't speculative edges. They're structural realities that matter more when flexibility is low. The silver market today is revealing something the paper structure had obscured. There's less metal available at the quoted price than open interest implies. That revelation doesn't require a crash to matter. It simply requires participants to adjust their assumptions about what their contracts actually represent. And that adjustment, already underway in Asia, will eventually propagate through the entire pricing system. Not because of panic, because of physics. You can't deliver what isn't there. Two takeaways matters here. First, about systems. Leverage creates efficiency until it creates fragility. The transition between those states is rarely visible in price alone. It shows up in plumbing, inventory levels, delivery times, arbitrage failures, localized premiums. Markets don't break loudly. They fracture quietly in places most participants aren't watching until the fracture is too wide to ignore. Second, about human behavior. We optimize for the conditions we've experienced. When those conditions change, our optimizations become vulnerabilities. Silver traders built strategies assuming arbitrage would hold. They were right for decades. The error wasn't in the strategy. It was in assuming the conditions that made it work were permanent. Awareness isn't about predicting the break. It's about recognizing when the margin for error has narrowed. Right now, across multiple commodity markets, that margin is narrower than the prices suggest. Not everywhere, not in everything, but in enough places that the pattern is worth watching. If this helped you see the system more clearly, consider liking the video and subscribing, not for predictions, but for perspective.